Hi, I'm Nguyen Doe, and I'm here with Mitch Wasserlin of CAPFUNDR and Tom Kaplan of Hamilton Real Estate Capital. They've teamed together to create a value-driven investment strategy focused in the Midwest. CAPFUNDR is an innovative investment platform that allows individual investors to invest in real estate funds online. Mitch, can you tell us how CAPFUNDR works and why you formed the company?
Yeah, my partner Ed, you and I have been in the institutional real estate world for our whole careers, and we wanted to enable individual investors to invest in the same kinds of funds that institutions have invested in historically. And we also feel that individuals shouldn't have to pay high fees to invest in these funds. So we formed CAPFUNDR to leverage technology and provide an online platform where people can come directly to our website without paying any broker fees, and they can access all of the information they need to find out about a fund, and they can actually complete the entire investment process online.
Why did you decide to work with Hamilton?
Well, we believe in very focused real estate strategies, and we also think that you need to have the right managers to carry out those strategies. And what we like about Hamilton and Tom and his team is that not only do they have great local knowledge of the Midwestern markets that they're operating in, but they actually also have a management company that's based in Columbus, Ohio, and that enables them to control the management of the properties, and it gives them access to great deal flow in those markets.
Great. So they're focused in the Midwest.
Yes.
So how is their track record?
Well, we think that track record is extremely important, and that was one of the compelling things about Hamilton, is that their previous funds, they've earned 28.6% annual returns for the funds that they've managed capital for. And while they may not be able to achieve that on this fund because we're pursuing a pretty conservative strategy here, I think it's a very good indicator of what they're capable of and of their expertise in this area.
Now, Tom, can you tell us a little more about the fund strategy? I see that you're looking at places such as Columbus and Cincinnati, and they don't quite have the same sex appeal as New York and San Francisco. So why your focus in the Midwest?
Well, we've always focused on fundamental value when we acquire real estate. We look for stable buildings that have generated stable cash flow for a number of years and that we can buy at an attractive price. If we look at the coasts at San Francisco or Seattle or Denver or New York right now, the prices are very high and the cash flow that you get is very low for the price. What we like about the Midwest is we're able to buy the same kind of cash flow at much lower prices, similar to what we've been able to buy in the past.
So there's still good pricing in the Midwest is what you're saying. What kind of net return should investors expect in this fund after fees?
Well, we're targeting 14 to 16% total return for the fund. We plan to start with a dividend of about 7% and grow that over time, and hopefully there'll be some modest price appreciation. So when you combine the dividend with some growth in the dividend and appreciation, you'll get to a 14 to 16% total return.
Are you buying fully stabilized properties, or is there room for some upside?
Well, yes and yes. We look for properties that have generated stable cash flow for several years, generally 20 or 30 years. We do also look at some modest, what we call value add, where there's an opportunity to improve the rents, for example, by adding new kitchens or new bathrooms. Sometimes with a renovated apartment, we can get a $50 to $100 increase in the rent. So we do look to increase the rent and increase the value of the property through modest investment. But fundamentally, we're looking for stable properties with strong in-place cash flow.
So I know a lot of real estate funds charge high fees. What are the fees for this fund?
So the fees that we charge are pretty typical of institutional real estate funds. The management fee is 1.5% per annum. There's also an incentive fee whereby the manager is entitled to 20% of the profits, but only after investors have received all their capital back, plus a 7% return. And we feel that that type of structure aligns the interests of the manager and of our investors.
Are there any fee breaks for large investors?
Yes. Investors who invest more than $250,000 will get a reduced management fee. And if they invest more than $1 million, the management fee will be reduced by 50 basis points. At $250,000, the fee break is 25 basis points.
Can advisors pool their accounts to capture this discount?
Yes. So one of the things that we want to encourage is for advisors to be able to access this discount by pooling different accounts that they have.
Great. Now, Tom, let's get back to the strategy. Do you intend to finance these properties that are being purchased, and what kind of debt would you be using?
Well, one of the reasons that we chose to focus on the apartment sector is that historically has been the least volatile sector, and the government agencies, Fannie Mae and Freddie Mac, by their mandate, their congressional mandate, are required to lend to the apartment sector. So if you look back, for example, in the recession in 2009, 2010, nobody was lending money to anybody in real estate except the government agencies were making loans on apartment buildings. So we find that that's a stable, reliable source of financing, whatever kind of market environment we get into. In today's market environment, we're borrowing money from Freddie Mac, Fannie Mae at around 4.5%, fixed for 10 years. And we like the option of, we plan to hold these buildings for about 5 years, but depending on what the market looks like in 5 years, if we're in another recession, we have the ability to hold on for a few more years until the market recovers.
Great, thank you. Can you give me an example of a recent acquisition you've made that would fit the fund's strategy?
Sure. We recently bought the Cardinal Creek Apartments in Columbus. I think it's very typical of the type of apartment that we'd be looking to buy for the fund. This is a 200-unit property. Rents are about $600 to $800 a month, so it's moderate income type of a property. It's fully occupied. It was built in the 1970s. It's been cash flowing pretty much since the 1970s, so it's got stable in-place cash flow. We are looking to make some improvements to the kitchens and bathrooms. We expect a moderate increase in rent on those apartments that we've targeted for renovation. But it's very typical of the type of building that we're looking for this fund.
Now, is there anything else that investors should know about the fund?
Well, real estate is an illiquid asset, and investors should understand that their capital will be tied up for 5 to 7 years. There's also a number of different risks associated with investing in real estate, and those are laid out in great detail in the private placement memorandum, which investors can access directly online on our website. So we encourage everybody to go download that private placement memorandum and read it very thoroughly.
Thank you, Mitch. Thank you, Tom. And that's it. Remember, www.capfunder.com.
Thank you, Nguyen.
Thank you.